Dhiraj Agarwal joins us. Let's connect with him. Dhiraj, good morning. Thank you for joining us. What do you make of the market mood? Is worst of the fall behind us?
Hi. I just lost you the last
Is
last
worst
half
of
a
the
line.
fall behind us? I mean, everybody is trying to understand that. Is there still some more downside left, or you think we bottomed out in the near term?
I mean, in the absolute near term, we may possibly see a bounce. Market's been falling for like 6 months in a row, which has never happened before. Last time we saw 5 consecutive down months was perhaps mid or late 90s, 97 or 98, somewhere at that period of time. So a short-term respite may be around the corner, looking at the market breadth in the last couple of days and the behavior of mid and small indices, which has started to lead Nifty, at least in this month, in the last 4 or 5 trading days, is obviously an encouraging sign for a near-term bottoming process. Longer term, I continue to maintain that we are not completely out of the woods. There are some headwinds. It's going to be a tough market if you look at 12 to 24 months point of view.
You think earnings are bottomed out, and if they're bottomed out, do you think it's a matter of time markets will start realizing that?
Sorry, what's bottomed out?
Earnings. आवाज खराब है, थोड़ी सर्दी हो रखी है, सॉरी. मार्केट में सबकी आवाज डाउन है धीरज भाई, इट्स ओके. सबकी आवाज डाउन हो रखी है इस मार्केट में.
Have the earnings bottomed out or not is a big question mark. I mean, will the earnings deteriorate from here? Perhaps not. But next 2 years, are we looking at market earnings growth of 8 to 10% versus going back to 12 to 15% is a big ask at this point of time. So I'm more in the camp that India is seeing a little bit of a cyclical consolidation within a long-term structural uptrend. And the cyclical consolidation may result in moderate earnings growth for the next year or two and a very, very tough up and down volatile kind of a market. Maybe not too much of downside from here, but does it go back roaring up back to the new highs or not is a huge question mark. I don't think so, honestly.
Dhiraj, let's probe that a little bit, and for the benefit of our viewers, because you're of the belief that there will be that polarization in earnings and stock price performance, and that's going to only continue to rise. Explain that for us, and what would it really mean for stock prices eventually, and the kind of return expectations one needs to have for the remainder of the year?
You know, I call, if you say the history of Indian markets in the last 30 years, it literally moves in a 5-3-5 cycle. So 5 years of runaway bull market followed by 3 years of consolidation, and 5 years of runaway bull market followed by 3 years of consolidation. Our institutional equities research strategist, Bharat, did a phenomenal job on, he's actually devised a concentration index or the polarization index, if you may want to call it. And the polarization index also follows a similar cycle. So during the 5 years or 4 or 5 years of one-way bull run, there is depolarization, or the concentration reduces, or the market breadth increases in simple terms. Larger section of the market tend to move up and move up very, very strongly. And then it's followed by 2 to 3 tough years where the polarization in the market increases. So if you see last 1 year, even the earnings are getting polarized. I mean, till 2 or 3 quarters ago, a large segment, 70 to 80% of the segment of the market was able to grow earnings at 15% plus. But in the last 2 years, that ratio is continuously coming down. So think about 2010 to 13 or 2018 to 20, where only 15 to 20% of the stocks actually give you meaningful positive returns. So there will be positive returns, there will be alpha to find. It'll be a little bit more difficult to locate them, and one will have to focus on numbers a little harder. That's what we mean by polarization.
But Dhiraj, in this particular market, quite an interesting take what you shared with respect to polarization. But what should be the best strategy to adopt at this point in time? Because Indian markets have, of course, seen the great run-up in the couple of years back then. But now, if we are in for some bit of a consolidation, what strategy should one adopt?
It's bottom-up. Sectoral, neither sectoral nor thematic strategy will work. So it's bottom-up stock picking with a huge amount of focus on valuation. So something that we had sort of forgotten or had started ignoring, I would say, in the last few years. But the current stock price moves and the market moves is very clearly giving us a message that we just don't want to see earnings growth, but we also want to see a very sharp razor eye focus on valuations also in the current market environment. So even within a sector, we will see dispersion, and it's already happening. In the last 6 months, we can see, for example, in banking, Kotak Bank is up 10%, whereas IndusInd Bank is down 30%, both private sector banks. BOB is down about 15%. In IT, we can see Coforge up 20%, LTI Mindtree down 20%, both second line IT names. And this kind of phenomena will happen more and more going forward in the market. And hence, more than sectors or themes, individual stock picking, sharp focus on numbers with razor sharp eye on valuations as well. Ignoring valuations and just look at earnings will not work.
So that's a very tough scenario then, Dhiraj, that you're painting right now.
That's
What
right.
are the pockets that you think can be those safe places that one can either buy, add on to positions, or maybe just wait it out for whenever the dust is to settle down, jump in there?
No, so as I just mentioned, there are no sectoral biases in this kind of a market, right? I mean, you'll probably find few buy ideas in all sectors. And hence to say this sector ABC will do well and sector XYZ will not do well, will not work in this kind of a market. And I actually see this market more like 10 to 13 rather than 18 to 20. So it's a tough market with a slight downward bias. And individual stock picking across sectors is what's going to work. 18 to 20, if you expand the horizon, 15 to 20, few specific sectors just kept on going up. So, for example, FMCG or select private banks, they just kept on going up. I think that's not going to happen this year. So trying to find sector winners is going to be challenging.
I understand that. So then what should our viewers do? I mean, give us some stock names then.
I generally try to avoid giving stock names in media, but I think you should look at earnings growth, quality of earnings, and valuations, and make sure you're not overpaying for your stocks.
Define what to your mind would be reasonable earnings for a company in next 2-3 years. I mean, let's say after COVID, 20% was the normal, then 15% became the normal, now 12% is the normal. What is reasonable earnings growth according to you, and what is reasonable valuation for next 3 years, considering that we could be in the early double digit for earnings now?
So I would say for Nifty next 2 years, earnings growth will be in the ballpark of 10%, probably slightly lesser than 10. And hence, if you can identify companies which can grow at 13 or 15%, that's pretty good. But one should try and make sure that for a 15% earnings growth kind of a company, one is not paying more than 25, 27 times P multiple. So I know PEG as a metric is looked down upon by hardcore fundamentalists, but as a crude measure, it works. So in the current environment, I would not go more than 2 times PEG, even for a fantastic company. And that will make finding stock ideas a little harder, but that's the reality of life.
Okay. Let's look at the pockets where growth is expected to be more than 10%. Fintech, banks. When I say fintech, internet companies, they will be more than 10%. Banks, more than 10% for sure. NBFCs, the base effect would kick in. I would imagine that for a lot of other FMCG companies, at least the good consumer companies, 10% growth should ideally come back as the base effect kicks in. So should start looking at themes in these pockets, because if one is buying IT, while a Coforge may have done well, but there is a tailwind, there is a headwind in the sector. If one is looking at buying capex, some capex stocks have done well, but government spending is slowing down. There is a headwind in that sector. Right. Can I primarily say that go for these 3 pockets and then do your individual work, which is consumer tech or fintech, to some extent banks, and to some extent consumer and consumer discretionary?
I would agree with a few of this. So for example, yes, in a number of areas within banking, valuations are now reasonable and earnings growth is also reasonable. So if not all, there should be a few bank names, and banks have been by and large, banks have been underperformers in the last few years, and earnings are still growing. So the valuations are consolidated. You can find winners in banks. Going to consumer discretionary, there are pockets of growth for sure. But in most spaces, if not all, I think valuations are still building in far steeper growth and discounting too much of future earnings at this point of time within the stock prices. So I would be a little wary about that space. Within NBFCs, yes, earnings are better, but the NBFC is it's a wide spectrum in terms of valuations. You can find NBFCs with 2 times price to book, all the way going up to 6 times price to book. I'm a little uncomfortable paying 5 or 6 times price to book in the current valuation-focused environment for the market.
Okay, Dhiraj, so great to have you on the show. Although we couldn't really get any stock names from you, but it was pretty apparent and evident that you got to be stock specific in this market. And yes, money making is not going to be as simple as we've been used to the last 3 years, perhaps. Good to have you on the show.
If you like this video, then like, share and subscribe to ET Now.